When we look at the equity markets now here and offshore, I'd probably say things are starting to approach fair value. So for a long time I've been coming out here saying equity markets actually look cheap relative to bond yields and equity risk premium. Today we're probably approaching fair value. The thing that we sort of hang on to and the thing that's probably worth reflecting on is, you know, bull markets never end when things reach fair value. So there's still a lot of supporting factors for equity markets here and offshore. Corporate buybacks are very high. There's still a lot of liquidity floating around. So valuation's now fair, but equity markets generally don't die on fair value. So look, it's well telegraphed and it's well priced in, so it'd be a big surprise if the interest rate rises didn't happen as expected. The thing that's sort of interesting for us is, you know, one of the topics I've been talking about, the forgotten risk of inflation. So that's one of the key drivers in the bond markets and interest rates. And right now, inflation expectations in the US and globally about as low as they've ever been. Central bankers all around the world are terrified about deflation, and they're focused entirely on battling deflation. And markets have priced that in, and you know, our view is that that's a dangerous game, because when you get to sort of maximum market bearishness, when markets are really pricing inflation out, the risk of a negative surprise or a non-consensus surprise is quite high. In the US in particular, there's sort of three top-down things that make us think that the market could be misinterpreting the risk of inflation. The economy's been going very fast, so growth in the US has been 2.5% annualized for the last few years. And what's interesting about that is most economists would say that's well above the potential growth rate. So you've got an economy that's actually growing much faster than it should be able to grow, according to the economists. Unemployment now is 5%. We're basically at full employment, and we're starting to see wage inflation come through in the data. So that's sort of the first signs of real inflation. And we've had these big deflationary shocks that sort of sat on the headline numbers, big fall in the oil price, big rise in the US dollar. So combined with all of that, we think that you know, it wouldn't surprise us if there was an inflation shock next year, or not a shock, but an inflation surprise, and that could have an outsized impact on markets, particularly interest rates. So a big part of forward interest rates is the inflation outlook.